Billions have vanished in the blink of an eye as the AI bubble bursts. What lies ahead will leave you speechless. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the once promising AI dream has spiraled into a chilling nightmare. It was heralded as a key to unparalleled efficiency, seamless customer experiences, and lightning fast decision making. And investors flooded into soaring tech stocks, lured by promises of innovation, skyrocketing profits, and ever increasing stock prices. But what the CEOs kept hidden from you is nothing short of shocking. Now let's over to Bloomberg, where we picked today's story with a headline: as Nvidia's $465 billion DeepSeek rout is the largest in market history and only gotten worse since that headline printed. And I want you to think back to Sunday, what we talked about, and that was corporate insiders have been selling stock at the fastest pace since 1988. It's because they know something about AI, and it's what they didn't want you to know. Now the problem is they knew you'd eventually figure it out. They just wanted to sell at the top. The semiconductor maker is leading a broader sell-off in technology stocks after DeepSeek's low-cost approach reignited concerns that big U.S. companies have poured too much money into developing artificial intelligence, since Chinese firm appears to provide a comparable performance to Western chatbots at a fraction of the price. And this is what the CEOs already knew that they didn't want you to know. They were already aware of DeepSeek. They knew it existed. They knew what it did. And the problem is that U.S. CEOs have told you that they needed to pour hundreds of billions of dollars into AI technology, that it was going to revolutionize the world, it was going to drive higher profits, higher stock prices, and investors bought big into it. The problem now is they're coming out with the truth, and that is they didn't need to spend all this money because there's much cheaper and more effective solutions out there, meaning other companies will be able to quickly and readily implement AI technology without having big tech budgets. For companies like Nvidia, this is the worst case news, as Meta announced plans on Friday to boost capital expenditures on AI projects this year by about half to as much as $65 billion, sending shares higher. This came on the heels of OpenAI, SoftBank Group, and Oracle Group's announcement of a $100 billion joint venture called Stargate to build out data centers and AI infrastructure projects around the U.S. And meanwhile, what have we seen? CEOs have been telling investors, look, we need to pour tons of money into this. We need big data centers. We need tons of energy, and we need lots of microprocessors. But the promise of what AI is going to do is going to completely revolutionize the world. But now the issue is, thanks to China and DeepSeek, we're finding out it can be done at a fraction of the cost. The problem now is investors are looking at test stocks and realizing they're potentially massively overvalued. And so you think back, CEOs were selling stocks at the fastest pace since 1988. Why is that? Because we're going into earnings season, and now that this got released by DeepSeek, what it threatens is for analysts to now reset the bar of what these companies need. It's going to force these CEOs to now answer questions on why they spent all this money that they didn't need to. And of course, what always happens when the big players get out of the top, they leave everyone else holding the bag. But they're not the only ones selling, as Goldman's largest clients are quietly dumping Magnificent 7 shares ahead of this week's mega tech earnings. So it appears that everybody knew about this except retail investors. The CEOs knew, of course. That means the investment banks knew they were selling shares, and they passed that information right along to their clients, who decided they were going to sell too. But that's not the only problem. We're at a massive inflection point that could lead to a huge raft of machine selling. Check this out. These are the technical levels from Goldman, and these are where the machines are positioned at. If we see the short-term pivot level break at 59.59 on the S&P 500, watch for a flood of selling by the machines. The medium-term level is 57.95. Long-term level is pretty far away at 53.14. The risk here is you get a big move down, then the machines start to sell, and next thing you know, you're going to see a flood of selling hit the U.S. equity markets. Let's put this in chart perspective as we take a look at the S&P 500. You can see at the time of filming that the S&P was trading just above that horizontal orange line. That is the short-term pivot level. The medium-term pivot level just below. Long-term, not even on the radar in terms of what we need to be concerned about. But you can see if it breaks that level of 59.59, watch for the machines to sell, and that's going to cause a mass amount of panic, particularly as we go into the earnings season for these big tech companies, and that starts on Wednesday. But if you're worried about what could happen to your portfolio, you should not worry, because we've shown our clients how they can make money without having to rely on big tech in their portfolio. Check this out. As of the close on Friday, our CTA Time Pro subscribers, they walked into the weekend with 12 open trades. 8 of them are up. That's a whopping 75% win rate. How about our Momentum Time Pro subscribers? They walked into the weekend with a 100% win rate. Keep in mind, we're not overexposed to big tech at all. Now, what do we do each and every day? We look at the machine positioning. That's our CTA Timer Pro, and we look to position our subscribers ahead of where the machines are buying, and that way they get in before the big purchase, and we look to get them out before the machines sell. But maybe you like to trade momentum, like those signals like the RSI and the MACD. Well, we run a proprietary overlay, and as you can clearly see by our win rate, we have a better outcome. Now, what do you get? You get the reports, you get the signals, you get my opinions on which trades I think you should take. We fully back tested our reports. You got stop loss levels to control your risk. We give you a weekly update on all our positions and updates on our stop loss levels as we go along. Here's the best part. You still can grab that 30-day free trial, because the market's maybe melting down, but there's other parts of the market that are going up. And here's the other best part. If you want to trade right alongside me, I'll tell you what I'm trading and when. You can buy right alongside me and sell when I do. Grab the links in the description below, and be sure to use that coupon code, because something that AI doesn't have the answer for, well, it's what's going on in China now, as the PBOC injects a record amount of liquidity using its new tools and delays further rate cuts. Now, let's talk about what's going on with China, because they have pumped their economy with massive amounts of stimulus, and we've said all along it wouldn't work. Well, sure enough, it's not, because what are they facing now is a massive liquidity drain. But you're not going to believe what happened in China over the weekend. Let's take a look. And it wasn't DeepSeek was the only thing, as the People's Bank of China conducted a 1.7 trillion yuan of so-called outright reverse repurchase agreements using 3- and 6-month contracts to keep liquidity ample. That's the biggest operation since officials started the program back in October as part of an overhaul of their policy toolbox. So what's happened? China stimulated their economy. They wanted things to turn around, and what happened? The big gaping hole of liquidity in their financial system only got bigger. PBOC had to come in and inject a record amount of liquidity into the banking system to try to plug the hole. The problem is, if we've talked about in the past, when central banks try to plug the liquidity holes, they can do it in a short-term basis, but never, ever does it work. The central bank has suspended another new program it uses for liquidity management by halting its government bond purchase this month. So that's interesting that in the past here, last year, we saw that Beijing was issuing a massive amount of debt to fund its stimulus. Now it's saying, wait a minute, we're not going to issue any more of those extra debt to fund stimulus. The move is likely an attempt to avoid fueling a record-breaking slide in yields that undermine the currency and weighed on confidence. And this is rather fascinating, because we think about the U.S. here. When we talk about massive amounts of deficits and debt issuance, what do investors respond by saying? They tell you that interest rates need to go up and bond prices need to go down. Now in China, what are they telling us? The exact opposite. The government was issuing a massive amount of debt, and now the experts are saying that's what caused interest rates to go down and bond prices to go up. It doesn't make any sense, because what the truth is about the situation is long-term interest rates are a function of growth and inflation expectations. So what China's bond market is telling them very clearly is all of this stimulus that you did, it didn't work, and it's not going to work. The gaping liquidity hole you have in your financial system, it's only going to get worse. And in fact, your economy is going to continue to trend lower, and that's exactly the validation we got over this weekend. As China's economy stumbles in sign of rebound as it hinges on yet more stimulus. And so now all of a sudden, we're coming out of a period post-pandemic where there was too much stimulus. It drove inflation. It was a big problem. And now we see in China, there isn't enough stimulus. We need even more. The question is why? Well, it's because interest rates are telling the Chinese government, the PBOC, and the people of that country that your economy is getting worse, and it's going to happen even faster. Factory activity shrank in January after 3 months of expansion, with the Manufacturing Purchasing Managers Index falling to 49.1, the lowest since August. Now, this is very interesting to me because what did we see? We saw a slowdown in manufacturing. Then we saw this kind of very soft, slight rebound, and everyone championed saying, look, the bottom is in. This is just the beginning. The green shoots are coming. And we said, wait a minute, hold on. This is how it works. You see moves down, they kind of plateau a little bit. You try to see if the dust is going to settle in the economy, and then you start to find out the truth. And we said the truth is the Chinese economy and the global economy wasn't getting better. That's exactly what this is validating. It's saying we're in the beginning stages of another leg down. And the non-manufacturing gauge for construction services dropped to 50.2. Now keep in mind, everyone said the services was going to drive the global economy forward. We said, nope, it follows exactly where manufacturing goes. And sure enough, now China's services sector is slowed to stall speed. Again, dangerous directions here happening in China's economy, all validated by the massive liquidity hole in the banking system that is only going to get worse. And on top of that, well, interest rates are telling us the economy also going to get worse as well. The disappointment followed other official data showing the government's fiscal support to the economy was weak last year despite the massive bazooka. Industrial firms reported third straight year of profit declines as deflation pressures persist, even though a program to subsidize purchase of consumer goods and machinery contributed to an earnings uptick in late 2024. So the government did all the stimulus and it helped a little bit, but not enough to change the direction of the entire Chinese economy. Keep in mind, they're the world's largest exporter. Who are they reliant on? Well, that's the world's largest importer. That's the United States and the rest of the world. So when you see demand from consumers all around the world slowing down, it impacts China's economy. There's nothing they can do to stop this because stimulus isn't enough. Now, if they could, for some way, drive a massive amount of internal consumption, they could possibly turn around their economy. The reality is it's not working. Let's take a look at the effects of slowdowns in industrial production. We're looking at some U.S. data here in blue. That's shown on a year-over-year rate of change against the U.S. U3 unemployment rate, that in red. And what happens when you get a slowdown in industrial production, even worse, a contraction when it falls below that horizontal black line, what happens? You see people go on unemployment and then they stay there because these are jobs that people can't transition to because other people in the manufacturing sector are also losing their job. You fast forward to right around 2007, what do we see? A bit of a slowdown in industrial production as it falls off a cliff going into 2008. What happens? The unemployment rate heads higher. And now, what are we hearing from people? That the U.S. economy is going to turn around in the next couple of months. The labor market is strong and resilient, but industrial production here is saying just the opposite. So when we think back to China, who's saying that there's a big slowdown, what does it mean for their labor market? That it means it's going to get worse. So you think about domestic consumption, you think from the consumer's perspective. China's saying, hey, look, we're stimulating the economy. We want you to go out and spend. And the workers are saying, we're not sure we're going to have a job. That is the risk here. And taken together, the latest set of figures reveal the world's #2 economy risk stalling. Well, it's not risking stalling, it is stalling unless the government stumps up more money, especially by the way of public borrowing and spending to plug a hole in demand. Well, it's a massive hole, kind of like the big liquidity hole in their financial system. Without a more pro-growth stance on the monetary and fiscal policy fronts, it'd be hard for China to prevent a sharper economic deceleration to 2025. And finally, the experts are waking up to what we've been saying is going to happen. That China's economy has not bottomed. In fact, it's going to get substantially worse. And both production and new orders fell to a 5-month low according to the PMI data. And a sign of weak global demand, new export orders dropped to the lowest since February. So not only is demand in China plunging, but demand all around the world is plunging. And again, what this means for Chinese workers, they're going to get their hours cut. Some are going to lose their job. And then it's going to happen again. More people are going to be on the unemployment line. The problem is Beijing, the PBOC have no answer. They've done the big bazooka stimulus and it didn't work. Just like we said, rate cuts, they've done that, didn't work. Nothing they're doing is working at all. And meanwhile, industrial profits at large Chinese companies declined 3.3% last year after a 2.3% decrease in 2023. A surge of 11% in December helped narrow the full year contraction, but that was only in December. We know that's going to turn around here in the first part of the year. And the problem is when profits contract, what do employers do? Well, they start cutting expenses. And when they've cut all those, they cut the next biggest expense. That's labor. Industrial profits are a vital gauge of the financial health of factories, mines, and utilities, shaping their investment decision in the months to come. And look at this, producer prices have fallen for more than 2 years and into 2024 with a 2.2% decrease. So here in the U.S., you hear people talk about how inflation is sticky now and it's only going to go higher, that we're in a new cycle. There's going to be a new era of decades of rising inflation because we already went through a downward cycle of disinflation. But that's not how it works, because if you own a business, say you own a factory and demand is going down, what do you do to stoke demand? Do you raise your prices? No, you cut your prices. So what we're going to see from China now is they're going to lead the world at exporting deflation. Now, of course, we know the Trump administration is probably going to react to that, but at least in the short term, you can see what's going on here. Deflation is going to start taking hold in manufacturing sectors all around the world. And the embattled property sector, meanwhile, shows little sign of sustained rebound. And keep in mind, we've talked about how the property sector is insolvent because the property developers have built a whole bunch of homes that they can't sell. And on top of that, the banks have lent them money, which you can see in the liquidity crisis that's going on inside of China's banking system that Beijing can't plug. Well, it's only getting worse as Hong Kong's property distress is catching up with the city banks. And keep in mind, we said this was coming, and here it is. Average prices of office buildings, shopping malls, and other properties have fallen more than 40% from their highs in 2018, eroding the value of collateral backing many bank loans. Defaults are also rising as more property owners and developers run into cash flow difficulties. So you can see what happens in a deflating economy is the banking system isn't creating enough new money to support all the asset prices. We said this is eventually what happens. Asset prices have to come down to the level of where the economy is at. This is something here in the U.S. that people do not want to accept as likely the course of action, because then it means that not only are asset prices such as office buildings and homes going to come down, it means stock prices are going to come down as well. And what we see is China now leading the world and telling everybody this is what you're about to face in the months to come. And banks are realizing if they don't sell their commercial properties, the value will go lower and lower. They have to sell a loss because that's how the market is now. But you think here to the U.S. and we talk about the regional banks who own a massive amount of commercial real estate. What's the problem is? They can't sell it at a loss because they don't have the money to absorb it. Now, they did lend against it. They don't actually own the buildings outright, but they could become owners when you see delinquencies turn into defaults. We know that is likely the path. So right now, the blow up in the AI bubble, very dangerous for investors, as we now could face a massive correction in the equity markets, one that won't rebound very quickly. Through, of course, a lot of talk from CEOs saying that, look, this is going to be the next big thing. Well, it turns out the next big thing may be the next big flop that is right behind China's economy. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.